Welcome back to Get Started Investing, a podcast where we answer all of your money and investing questions. If you've just joined us for the very first time, a massive welcome. We do recommend that you scroll up and start at episode 1 if you're looking for the basics on how to get started and feel confident about investing in the stock market. Otherwise, we have a huge episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are up to episode 3 of our 4-part series, our end of financial year health check. We've covered our goals, our portfolio construction, what our strategy is for the year ahead. And now we're going to get into the nitty gritty and really focus on one feature of investing that affects us all, that can have an insidious effect on our long-term financial outcomes, but doesn't get the focus it probably should.
Well, with that sort of a runner, today's episode is all about fees and making sure that A, you are aware of what fees you are paying, and B, if they are the cheapest in market, and if not, that you understand and can justify why. So we're going to be talking about what fees we pay for our ETFs and managed funds. We're going to be covering, are there any cheaper alternatives? Answering the question around how much we're paying for brokerage, and if there are any other platforms, news sites, or subscriptions that we're paying for.
That's right. So 4 questions on today's checklist. Before we get into it, we want to say a huge thanks to our friends at Superhero for proudly supporting this winter series.
Superhero has Australia's happiest investors, awarded CanStar's Most Satisfied Customers Award in 2023 for online share trading. They're feature-packed for a fraction of the cost, including $2 brokerage for trades up to $20,000.
Get access to award-winning features and amazing value from the get-go. Get invested, trade for $2 with Superhero.
It is worth noting that Superhero does not provide financial advice, and you should consider whether their product is right for you. $2 brokerage is for trades up to $20,000 and in the relevant currency. T's and C's do apply, and you can read them or download the Superhero app at superhero.com.au.
All right, well, let's get into this episode. You outlined the 4 questions that we're going to answer for our fees checklist today. The first one is, how much am I paying in fees for ETFs and managed funds? And in our mind, the action here is to list out every ETF and managed fund you are invested in and their fees. Now, if this feels like too daunting a task, you might have too many lines on your portfolio. You might have too many different holdings.
That's a comment, is what you're saying. Like if someone sits down and goes, "This is way too many,"
this is gonna. I need
probably need to. Yeah, you probably need to reconsider how many ETFs you have.
Yes.
Yeah. How many is too many? The age-old question.
And to be clear, so if you're investing in an individual stock, they won't have a fee. There's a brokerage fee to buy and sell, but holding it, there's no fee. If you're investing in an ETF or a managed fund, there is a fee. It's sometimes called a fee. It's sometimes called an expense ratio. It's sometimes called a management fee. There's probably other names for it that I can't think of right now.
Those are the main ones, yeah.
They're the main ones.
Yeah.
You sometimes say it just MER as an acronym, but they all mean the same thing. It's the fee that the fund manager charges to manage the fund on your behalf.
Yeah.
We want to make sure we're paying as little as possible.
Yeah.
And to give you just an idea of the large difference a small difference in fees can make over a long period of time, we did some maths on Warren Buffett's Berkshire Hathaway, the holding company that he used to invest and sort of grow his wealth. If you had invested $1,000 in Berkshire Hathaway in 1965, when Buffett takes it over, by 2019, you'd have had $27 million. Pretty amazing from one $1,000 investment.
Love that.
If Buffett had charged a 1% management fee, you'd have $25 million. Still pretty amazing. Bump that management fee from 1% to 2%. Doesn't seem like a massive difference, 1%, 2%, it's all small. You go from 25 million to 9 million.
Wow.
That is the big difference small changes in fees can make.
Double the fee, more than double the erosion in returns.
Yes.
Yeah. Wow. Well, that frames this well. So let's answer the first question. How much are we paying in fees for our ETFs and managed funds? I'm going to speak about my 4 core ETFs
I'll do
and
the
my
same.
my managed fund. I'm going to leave to the side a number of my thematics just for the purpose of this exercise. So I have a Australia ASX 200 fund. It's the Beta Shares Geared, GEAR. It has a management fee of 0.8%. Now, we'll talk about comparisons in the next question, but for now, 0.8% is the management fee. For my US, it's GJUS. It's the Beta Shares Geared US S&P 500, so that it's also 0.8%. For Asia, I've got Vanguard's Asia VAE 0.4%. And for Europe, I've got Vanguard's Europe, which is VEQ 0.35%.
Nice.
So that's my core. It is worth noting as well that I have a position in a managed fund, unlisted managed fund with Fairlight. They are a small cap fund manager, and they charge 1.3%. Now, I'll get to other cheaper alternatives and why, but that's the fees. Very easy to find all of this information. You can find it on the product issuer's website, and I suggest you do the same for yours.
Yep.
Ren, what about you?
So I've just looked at my core portfolios. So 5 ETFs, starting with Australian shares, the Vanguard Australian Shares ETF, 0.07%. Then going to the US, iShares S&P 500, 0.04%. Heading over to Europe, I've got the UK specific FTSE 100, 0.45%. And then mainland Europe, 0.56%. And then finally bringing it home with Asia, Vanguard Asia ex Japan, 0.4%.
Nice. So there are definite differences between the fees that we're both paying for similar exposures.
Yep.
So then the next question is, well, now we know what our fees are. Are there cheaper alternatives? And if there are, can you justify why you're not in that product? Because I think that's a very important consideration. Whilst we do say you want to keep your fees as low as possible, there are caveats to that.
I think the general rule is all things being equal, you should be paying for the lower fee. You should be paying the lower fee. So if you're going to pay a higher fee, then you have to say all things aren't equal. There's a reason that I think this fund is better or just more suited to my goals or my investing style. And some of the reasons that we listed, maybe it's a more trusted or better performing manager. Maybe it's a better investment strategy. Maybe it's something as simple as your dollar cost averaging and the ETF has a lower unit price. So there are plenty of reasons why you might choose it. But the important thing in this exercise for your end of financial year checklist is do the work to say, what are the fees am I paying? What are the other options out there? And if I'm not paying the lowest fee, why?
Yeah.
So Bryce, let's do that exercise for you to begin with.
Sure.
Some of those I know aren't the lowest fee options available.
Yes.
So talk to me about your thinking.
So let's start with Australia. What I want is exposure to the ASX 200.
Yep.
Cheapest I'm paying 0.8% through my Beta Shares Geared ETF. Cheapest on the market is the Beta Shares A200, 0.04%.
Put another way, you're paying 80 basis points and the cheapest is 4 basis points.
Yeah, so significantly higher. The reason is they are not equal products. The geared product that I have is essentially there's underlying leverage that is managed by Beta Shares. So there's more running costs and management costs that go into this ETF that give me it's a different strategy, essentially, at the end of the day. And so obviously they need to incorporate that into the management cost. Now, I need to be able to justify that I should be getting better returns. We've done this exercise on the show, but that is why I'm happy with paying this, because I like the strategy of being leveraged in this ETF. And the exact same goes for GJUS, which is the US. The cheapest on the market is the iShares IVV, and it's 0.04% as well. So again, I'm paying 80 basis points. I could be getting it for 4. But again, the Beta Shares GJUS, it's a leveraged product. I'm getting 2.5 to 3 times the returns also 2.5 to 3 times when it goes down. But I've made a conscious decision to be in those for my core portfolio.
Nice.
When it comes to my Europe, the Vanguard Europe Fund 0.35%, that is one of the cheapest on the markets. I look across the board, iShares is 0.59%. So, and the same goes for my Asia. Vanguard Asia is 0.4%, one of
Nice.
the cheapest on the market.
Nice.
So I'm happy with those two.
Nice.
Yeah.
So I've done a similar exercise, and there are some where mine isn't the cheapest. So you mentioned there that the iShares S&P 500 is the cheapest for that. I'm glad to say that that's the one I'm invested in.
Nice.
But for my Australian exposure, you said that the Beta Shares A200 was the cheapest, 4 basis points or 0.04%. My Vanguard Australian shares is 7 basis points, so 0.07%.
VAS?
VAS, yeah.
Yeah. Slight nuance though, because A200 is 200, Vanguard is 300
Yep.
stocks.
Yep.
So you could argue you're getting exposure to more stocks.
You could. That's not the reason that I do it.
Yep, fair.
And to be honest, the bottom tail of 100 stocks doesn't really move the index like the top end.
Yeah.
The reason that I do it is actually a lot simpler. When I set up my dollar cost averaging, I was putting $100 into this VAS every fortnight.
Yep.
You can't do fractional Aussie ETFs at the moment.
Yep.
And the A200 ETF, it's like about $130 unit price. It was too much. I just
couldn't get it.
I'd have to invest more than I wanted to invest.
Yeah.
The VAS was about 90, just a bit under, in the high 80s. So I was like, that's fine. I'll dollar cost average. I'll buy 1 unit of that every fortnight. The problem is now it's $97, and so it's getting very close to above that $100 limit.
So will you have to change the frequency that you invest?
No, I'll just have to contribute more.
Yeah.
But yeah, the reason that I do it is just because it made more sense with my dollar cost averaging strategy. And it's not a massive amount of money. Like, there's sort of $30, $40 difference. But it was just like the amount that I could comfortably contribute to investing, how I wanted to split that. It just made more sense to go the lower unit price.
And if you can't contribute more, the action here is to find a cadence that allows you to get the $130 or whatever it might be every 6 weeks. Or okay, so you're comfortable with that?
Yep.
Yep.
And the other one that wasn't the cheapest, so I invest in the Beta Shares Europe ETF, which is 0.56% fees. Now, your Europe exposure, you said, was 0.35%. So I'm paying more than you.
You are.
The reason that I'm comfortable with that is your Europe ETF is Europe and the UK all in one.
Yep.
It has about 28-30% of its holdings in the UK. Its biggest geographical weighting is the UK. I like to separate Europe and the UK just because, in my mind, they've got certain, like, different characteristics.
Yeah.
In the same way that Asia and Japan can be seen as quite different, mainland Europe and the UK, maybe not as extreme, but, different. So I just like having them separate. And so my Europe exposure is slightly more expensive, but it's got a heavier weighting towards France and Germany and the Netherlands, which is something that I am happy to pay more for.
Yeah.
So yeah, that's a few of the areas where I'm paying a little bit more and the reasons that I'm doing it.
Nice.
Yeah.
All right, well, we're going to take a quick break. On the other side, we're going to be deep diving into how much brokerage we're paying and then also what we're paying for in terms of other platforms and resources. But before we do, we want to say a big thank you to Superhero for supporting this winter series.
Equity Mates, if you're looking to make the most of your investments without breaking the bank, you need to check out Superhero. It's been awarded Australia's best value online share trading platform, offering plenty of features at a fraction of the cost. As you know, we hate fees at Equity Mates because they eat away at your returns. So keeping brokerage as low as possible is important, especially if you're regularly investing into your core portfolio.
With Superhero, you can trade ASX and Wall Street stocks and ETFs with $2 brokerage. So you're ready to get started?
Get invested. Trade for $2 with Superhero today.
$2 brokerage is for trades up to $20,000 and in the relevant currency. T's and C's do apply, and you can read them or download the Superhero app at superhero.com.au. Welcome back to Get Started Investing. We're covering off all things fees today and doing a deep dive on our portfolios to make sure that we are paying as low fees as possible that makes sense for our investing strategy. Ren, before we dive into looking at our brokerage, there's actually one point that I want to cover off that we should have discussed when we're looking at alternatives. If in the instance I've found that one of my ETFs is actually higher and I do want to change, what's the best way to do that? Sell out of everything and move all the funds across, or just acknowledge that there's a better alternative and start building up? This is a question that we've had in the Facebook community and a valid one. How would you think about doing that?
My gut is, especially if you're earlier in your investing journey, in your 20s and 30s, now would be the time to get it right. Because, you know, like there will, if you've made money on that position, there will be tax, but it's going to be less tax than if you let it grow for another however long and then you sell it and you rebalance. And like, whilst you're letting it grow, you're paying higher fees. I think it's like, I know we spoke about rebalancing earlier and we spoke about the merits of rebalancing slowly over time. I think the caveat there is you want to have the right infrastructure in place and then you can sort of manage where money goes within that infrastructure. But if like the positions are wrong, change them.
Yeah.
Because it's always going to be more difficult to change them in the future, just from like there'll be more tax or more admin. And I would certainly say you don't want to double up. You don't want to be like, oh, there's a better Asian fund now, so I'll keep my Asian fund and then also invest in this other Asian fund. Because like it's just complexity and it's just messy.
Yeah.
Just like keep your portfolio simple and consolidated in the best possible options and then regularly invest in them over time.
Yeah.
That would be mine. I actually realized as we do our cleanup from our earlier session, there was one fund that you mentioned that you said you'd get to later and you didn't get to.
Oh yeah.
Fairlight.
In what sense?
Well, you said they charge 1.3% in fees, and I'll talk about that later, and then you didn't.
Oh.
So just in terms of not leaving any loose ends.
Sorry, true. I think my point was, why am I prepared to pay 1.3%?
Yes.
It's because it's a lot when you put it into context. That's 130 basis points versus 4.
Yeah, you just compare that to all the other ones we spoke about, which were less than 1%.
Yeah. So you look at that and you go, wow, that's considerable. The example you gave with Buffett at the start of the show, you know, they were in the 1s and 2s. And so when you do start getting in those realms, you do really need to justify why you're paying that. And for me, it's because I'm paying for the expertise. And what I mean by that, this is a fund that is investing in small cap stocks, concentrated portfolio globally. And it's just, I don't have the time and the resources to dedicate to finding small cap stocks like these guys do. And I've also learned through the journey of investing on the show that taking an index approach to the small cap market is not the best way to go about things.
Yeah.
I don't want just a broad-based 2,000 of the smallest stocks on the S&P 500. That's not what I'm after when it comes to small caps. So I'm prepared to pay the additional fee, knowing that I would hopefully be getting a better return than if I were to try and do it myself.
Yeah. And to be perfectly frank, you're not paying for expertise. You're paying for after fee performance. And if you look at Fairlight's track record, they've outperformed their index after fees. And really, like, as long as they keep doing that, that's how you justify paying those fees.
Yeah. But good loose end.
Anyway, not an ad.
Nice.
So there are 2 more questions that we want to cover off in this fees-related checklist. How much am I paying in brokerage? Because that is a cost. And then finally, are there any other platforms, news sites, or other subscriptions I'm paying for? Because again, all costs matter. Because the theory is, if you minimize your costs, you're freeing up more money to invest. And if you invest that money, then over time, you're going to do better. So, question 3, how much am I paying in brokerage?
So I'm paying $2 for my core investments across ETFs and stocks on the ASX, and $2 to $3 brokerage AUD and USD on direct investments.
Yeah. So I'm the same as you.
Which is awesome at the end of the day.
Dude, like when we started, 1995 was standard.
We didn't start in 1995.
No, I wish we started in the year 1995.
$19.95.
$19.95 cost.
Yeah,
Was
standard.
the standard.
I
And
know.
now it's $2, $3. Like,
Yeah.
so good.
It's awesome.
Yeah.
Yeah. So thank you to the online brokers out there making things more accessible.
And thank you to Superhero for making this series possible.
Yes.
So I guess the question that for people doing this checklist at home, because they
Mm.
may have different setups. I think the first question is, what am I paying?
Mm.
Second question is, are there cheaper alternatives? And similar to what we were doing with our fees before, if I'm not in the cheapest option, why?
Yeah, so there are alternatives. For me, I'm happy. I'm happy to pay what I am. A, because it's ultra low.
Yep.
Moving is not going to get me like outsized returns,
Mhm.
but also the capabilities and the features that I have when it comes to automation are super important to me. And so, from a total end-to-end process, I'm really happy with everything that I have in my brokerage platform at the moment.
Yeah.
What about yourself?
Everything that you said,
Nice.
I agree with. Partly because we've been doing this show for 7
Yes.
years, so it's not surprising that our views align. But also, yeah, we have very similar setups. The other fee that people should be aware of is the foreign exchange fees.
Yeah.
So now that because the other great thing that's happened since 1995, both the year and the brokerage cost,
Yeah.
is that we can now invest in a lot more countries.
Yeah.
Like even when we started, investing in the US was so hard.
Super difficult.
Yeah,
Paperwork, different accounts.
It makes us feel old.
I know.
And now it's super easy. But the other way that cost can sneak into your brokerage is exchange fees.
Yeah, and so this means every time that you put currency into US dollars from your Australian dollar account, there is a fee that is attached with that. We're paying 0.65% every time that we convert into a USD. To be honest, for me at the moment, that's not very frequently. This rate is competitive based on a number of other brokers that I've looked at, so I'm happy with 0.65%. But as I said, it's not something that I'm actually doing a lot of.
Yeah.
If it's something that I'd be doing every time I'm dollar cost averaging or whatnot, I might be looking at alternatives. But for me, I'm really happy with that, and it works for my investing style.
From what I've been able to research as part of this sort of health check, it seems like that 65 basis points is kind of in the ballpark of a lot of the brokers that we would use or other people would use.
Yeah. So, Ren, one question I have that comes through the Equity Mates community is the impact on brokerage over a long period of time when it comes to dollar cost averaging, but more importantly, figuring out what the right amount to put in each time versus your brokerage so that you're maximizing the returns.
Yep.
You have a calculator? Is that right?
I have
You
the
personally
link.
don't have one.
I have the link to a calculator, which everyone can have if they go to our show notes.
Nice.
So it's the investment frequency calculator, and it looks at how often you're paid, what you're putting away as savings to be invested, what your interest is on your savings account, what your expected investment returns are, and then what brokerage you pay per trade. Calculates all of that and tells you the optimal investment frequency based on all those inputs.
Nice.
So
nice.
I'll check the show notes. We'll put the link in there, and you can have a play around with that with your own personal circumstances.
Nice, because I think at the end of the day, whilst we're paying $2 brokerage, if you're paying 3, 5, 25, you really need to consider the frequency that you're doing it, because it does make a difference over the long term.
Yeah. I mean, yeah, it does.
Yeah. All right, so we're happy with our brokerage. The final question is, what else are we paying for? Are there other platforms, news sites, or subscriptions? Is it worth it? Can I justify it?
Yeah. Well, I mean, let me answer that question first. All of my news websites, I get Equity Mates to pay for.
Yeah, that's what I hear.
So that's a point of privilege that I'm
Let's put it
aware
this
of.
way. If you had to pay for them personally, are there any that you get a lot of value from? Because I think, again, we've had a question in this week in the Equity Mates community, what subscriptions are worth paying for?
And then, so after news, then it's really, like portfolio tracking. I don't pay for portfolio tracking. I know a lot of people do, like ShareSite is quite popular and I can see the value proposition. For me, the sticking point has always been getting all of my past data into...
That's always your sticking point.
Well, it still is my sticking point. In fact, the longer I invest, the bigger that sticking point becomes because there's more history that needs to go into it.
Get your foundations right.
Look, to use my position of privilege again, ShareSite, potentially you want to give me someone to put all my details in for me, and then I'll be your biggest advocate. So, Bryce, I can quite happily say here, there's not a lot of subscriptions that I pay for.
Yeah.
What about you?
Yeah, so ShareSite is the only one for me as well, portfolio tracking.
Yeah.
Otherwise, I'm in the same boat as you. Very much appreciate Equity Mates paying for a lot of the news subscriptions. But yeah, I don't pay for any monthly stock reports or anything like that. And none of my brokerage or none of the platforms I use have a monthly subscription attached to them or anything like that. It's just transaction costs. So, there's nothing wrong with that. But if you do find them valuable, then by all means. I think the final thing is we've both recognized that Equity Mates pays for. What of those subscriptions that would you keep if you had to pay for them, or do you actually get value from, just in case that people at home are like, we are in...
From a news point of view?
Yeah, or just from a news point of view or information point of view.
Slightly controversial take, but I would say none of the news websites help me with my investing.
Okay, yeah.
I think people who are more attuned to the news are often worse investors because they are constantly getting new information and they feel that they need to act on it, that things are changing and therefore I should be reacting and my portfolio should change as a result. Whereas I think time and time again, study after study shows that people that stay the course with a strategy and don't react to short-term blips, which is what most news is, do better. When how people think markets will react to news is often not how it reacts. And so people often end up positioning themselves incorrectly. So I'd say that news can often be a hindrance. But that isn't to say that news doesn't have value. Like, I love being informed. I love keeping up to date. The New York Times has become a real staple of my bus ride into work. Shout out to the Wordle connections and spelling bee games who keep me entertained on my bus trip from Maroubra. But yeah, in terms of like optimizing investing outcomes, I controversially sit on the side of no news is good news.
Fair call.
What about you?
Yeah, I mean, I'm not making any investment decisions based off what I read in the AFR. Yeah. But I like reading the AFR.
Yeah, same.
And I like reading the Financial Times, and so I do get value from it. But yeah, I'm not changing the way I invest based on anything that happens in that.
It can prompt you to like research a company and stuff like that. But my biggest gripe with business news these days is that like how many stories do we need about the big four banks and the big law firms? Like, I'm not making investment decisions based off that, or I'm not discovering new companies based off that. So I'm just hearing about the same old.
Yeah.
Anyway,
yeah. So that's probably a good place to leave it. Just to cover off what we have spoken about today when it comes to fees. Firstly, figure out how much you're paying for fees in your ETFs and your managed funds, and then do a comparison to find if there are cheaper alternatives and justify why you are paying for higher fees. Then have a look at your brokerage account and figure out what you're paying in brokerage. Again, do some research to find out how that compares to other alternatives, and then look at platforms, news sites, and other sources of information and subscriptions to get a sense of your total fees that are going out on a monthly basis.
Yeah, nice. Well, that brings us to the end of our third episode. We've got one more to go, which is all about superannuation, the absolute superpower, monster, biggest free kick in finance, most neglected but most important thing when it comes to our finances.
Yeah.
So I can't wait for that one. But before we get to it, we want to say a big thanks to our friends at Superhero for making this series possible.
Trusted by us and 300,000 customers and winner of Moneymag's best value share trading platform 3 years in a row, Superhero offers you a range of features and amazing value no matter where you are on your journey.
Get invested, trade for $2 with Superhero. $2 brokerage is for trades up to $20,000 and in the relevant currency. T's and C's to apply, and you can read them or download the Superhero app at superhero.com.au.